Got it. Makes sense, Zane. And many managers will perform well in bull markets, but struggle in market stress. So, what have you done to generate positive returns in both bull and bear markets?
Yeah, this is one of the most important questions in a public market, right? It's not just, when the market's doing well, is the strategy doing well? And if it is doing well, what is the alpha being generated above that? And if markets are suffering, how does that affect the trading system? So I would go back to the thing I posited earlier, which is more durable trading systems are very subject to market movements because they're built on the normal structure of the market. So when a market tanks or has a bear market or has a major sell-off, black swan event, that becomes less about normal market structure and more about anomalies. So there are some systems that do really, really well during anomalies, like a major correction. The issue is if you rely too heavily on the traders that do really well in those circumstances, that edge that they have during those very specific times can start to erode. So it's really not like a good long-term solution for building wealth, focusing on traders that are really good at anomalies. On the other hand, if you focus just on the traders that are good at like the normal market regimes of 80% of the time the markets are trending up and they're slightly outperforming or maybe greatly outperforming, creating alpha, then at that point, then you're relying on systems that could easily start to break when there is downside, right? So there's really very few systems, if any, that are good at both. So the solution we've come up with, as rudimentary as it sounds, is to diversify across both types of systems. And that's a very straightforward sounding approach. But what that really means is understanding at an individual level of trading systems and managers whether they're long biased or short biased, why are they generating the returns they are, and is it from more of the anomalies, or is it more of standard market structure that's creating that? And so our goal is to always try to figure out, a trader has been successful in the past. Why? Was it luck, or is it something durable, or is it based on anomalies? And if it's based on anomalies, is there a way to integrate them into our portfolio of managers that's not going to, in the good times, erode the upside of the ones that rely on the benchmarks? And I know that was like a really long answer, but basically what we're trying to do is kind of have the best of both worlds. And that can be difficult to do that. And a lot of it just comes down to really a very rigorous review process to understand why their trading is working the way it is and how it could fit into our portfolio. That way we can pass that on to our investors as well.
Got it. And